I now hand the conference over to Mr. Krishna Bodanapu. Thank you, and over to you, sir.
Thank you very much. Good evening, ladies and gentlemen. And firstly, my apologies for having this call this late in the evening. As you know, given the current situation, logistics are becoming quite a bit of a challenge. So our board meeting only closed about an hour ago. So this was the best time that we could do, and I really appreciate you taking the time to be on this call today evening. Welcome to the Cyient Limited's earning call for the first quarter of financial year 2021. I am Krishna Bodanapu, Managing Director and Chief Executive Officer of Cyient. Present with me on this call are our Executive Chairman, Dr. BVR Mohan Reddy, President and Chief Financial Officer, Mr. Ajay Agarwal, and President and Chief Operating Officer, Mr. Karthik Natarajan. Before we begin, I would like to mention that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. A detailed statement in this regard is available in our investor update, which has been emailed to you and is also posted on our corporate website. This call will be accompanied with an earnings call presentation. Details of the same have already been shared with you. With this, let me take you through the highlights for the quarter. We posted quarterly revenue of INR 9917 million. This signifies a degrowth of 7.6% on a Q-on-Q basis. In US dollar terms, we posted revenue of $130.6 million, which is a degrowth of 12.5% on a Q-on-Q basis and 11.6% in constant currency terms. Services revenue stood at $112.2 million, which signifies a degrowth of 15.2% on a QOQ basis and 14.3% in constant currency. EBIT margin stood at 5.2% for the quarter, lower by 328 bips on a Q-on-Q basis. Services EBIT, however, was at 6.7% for the quarter, which is lower Q-on-Q by 283 bips, primarily because of lower volume. DLM revenue for the quarter stood at USD 18.4 million, which was up 8.5% on a sequential basis. DLM EBIT stood at minus 4.6% for the quarter. Net profit for the quarter stood at INR 814 million or 81.4 crores, which was a growth of 8% on a Q-on-Q basis. Free cash flow for the quarter stood at INR 2163 million or 216.3 crores. Free cash flow to EBITDA conversion for this quarter stood at 138.1%, and Ajay will explain the details a lot more in his presentation. Now, coming to the business highlights for the quarter, I think we had a very good quarter in terms of some of the deals that we have signed. One that we achieved was a deal that we signed with Hitachi Rail, where we signed an agreement to deliver a series of engineering service projects to support and accelerate evolution of their signaling technology. And we will operate a central delivery center for them in India and a regional delivery center for them in the US. You would have seen a press release to this effect a few months ago. In addition to Hitachi, there were two other new deals that we signed, which are multi-year, multi-million dollar deals. And what I would like to report on that is that in spite of all the challenges that we face, I think our sales pipeline is doing very well, and we are being able to drive momentum into the sales process and into closures in spite of the challenges that we face with not necessarily being able to travel. We also signed a collaboration agreement with Microsoft we have an IoT Edge Gateway, the 5400. It is a very unique solution in the sense that it combines hardware and software together, and it's been a very interesting solution. And now that it is certified by Microsoft to be Azure compatible, it can go into a lot of applications where the data also has to go into the cloud. We also commissioned the Hyderabad Blm Factory. This is one of the most advanced electronics manufacturing facilities in India, and it is underpinned by the latest technology in factory automation, Industry 4.0, and supply chain management. It gives us a very good advantage because it's located close to our design centers, and also it gives us the advantage of being able to showcase some of the services technologies that we're implementing for our customers in terms of automation, in terms of automation, Industry 4.0, and so on and so forth. I'll also say that we have added 25 new customers. What you see in front of you are some pictures from the facility. It has been commissioned. We are now doing qualification runs, and serial production will start from August 2020. We have added 25 new customers in addition, or I guess including the 3 that I talked about, which are strategic long-term deals. On top of that, we've added another 22 new customers in Q1FY21, which is again a good reflection of the fact that closures are continuing. We are cognizant of our dependence on the top 5 customers, and we're looking at de-risking this concentration in the long run. Of course, this is easier said than done, but growing the next set of customers is a strategic goal, and what you will see over the next few quarters is we're making some very, very good progress on that. In terms of also I want to reiterate that we are very confident in the long-term future of the organization, and in that context, we've also made 3 very senior hires. Felice Gray Kemp joined us in the US, but she will be the Senior Vice President and Global General Counsel, so she has a global responsibility. And she comes with a significant amount of experience in a number of general counsel areas such as legal, compliance, risk management, and so on and so forth. We also added Meenu Bagla as Vice President and Chief Marketing Officer. Meenu also comes with about 20 years of experience in marketing, and the mandate to her is really to strengthen both the outward-facing marketing and also the communication that we do internally, because while the Cyient brand is very strong, we could do a little bit more in terms of communicating more forcefully and effectively. Lastly, we also added Richard Palm as the Vice President of Supply Chain for DLM. As we had talked about previously in many instances, the key to the success of the DLM business and the key to competitiveness of the DLM business is a strong supply chain. We believe that Rick actually comes with 25 plus years in this area, having managed multi-billion-dollar electronic supply chains for people like Jabil. And he will be responsible. He's based in the US, but he will be responsible for our global supply chain as we procure a number of components from a number of places that can ultimately be manufactured in India or elsewhere. So what I would like to reiterate on this is that we continue to be very confident about the business, and therefore we're bringing in some very, very competent individuals, both into some new roles that have been created, but also into roles where we can show significant amount of difference to our business and really participate in the growth that is going to happen going forward, which we will talk about. I also want to quickly highlight the fact that we have been a very good corporate citizen in these rather difficult times. The first priority, or the first and foremost priority, has been associate health and associate safety. We've done a number of things to make sure that both physically associates are safe, but also this is a unique situation where people are not able to go about their daily routines, which means that mental health also becomes quite important, and therefore we've done a number of things over there. We have worked with the government in deploying technology for effective management of COVID-related issues. For example, we work with the Telangana government in deploying drones to help them manage the areas that are affected or potentially affected by COVID a lot more effectively. For one of our key customers, MolBio, we have significantly ramped up manufacturing for them to produce COVID testing devices, and that's something that we've done very quickly. And we continue to double down on our existing commitments, though, as many of you know, primary education and child education is an important aspect for us. Though that has come down because a number of schools have closed, we continue to do a number of things in supporting communities that we work in, both in India and outside of India. So that is where our commitment to corporate responsibility continues, and as things return to normal, we will continue that commitment. With this, I would like to hand this over to Ajay, who will take you through detailed financial performance for the quarter and the year. Thank you. Ajay, over to you.
Thank you, Krishna, and greetings to all of you. And again, thank you so much for taking this call little late, especially for the people from India. So I'll present to you the financial update. Let's go to the revenue slide, please. First, I would say that, this quarter, I think internally has been very satisfying. It has been we have delivered inline results in terms of what we were expecting. The predictability for us to plan our revenues and cost has improved during the quarter, and we had initiated and we had talked in the last earnings call our focus on cost optimization and cash conservation, and you would see that some of that is showing up in the results. So let me start with revenue, as Krishna already spoke about. These are some of the numbers in terms of the revenue. $130.6 million, quarter-on-quarter change of minus 12.5% constant currency will be that's it will be a little better. Year-on-year about minus 16.6. At services level it is minus 15, and for DLM it is 8.5%. In terms of geographies in line, only thing I have to report is in terms of APEC, we are seeing significant upside, and the traction in communications and APAC is really coming back. And Karthik will talk more about the segments. In terms of the profitability, I would say that we had a lot of focus in this quarter in terms of cost optimization, and we worked both on revenue and cost to the plan, and that's reflected in some of the numbers that you are seeing. If you see, our reported margin for the quarter is 5.2% in terms of EBIT, and in terms of the EBIT that is reported is 511 million INR. And if you look at this margin, I'd like to give you some sense of it, that from the perspective, and we have provided an annexure on the details of the margin movement, which you can read. The gist of it is that there have been headwinds and tailwinds, and there have been one-offs, and some of those one-offs will not be there in the next quarter. So if you look at, we have worked on the cost optimization that involves some restructuring costs. We definitely had some headwinds on the absorption with a decline of 12-13%. We also had one-time adverse revenue mix, which is not expected in next quarter. And then in absolute term, there has been significant reduction in SG&A. We have improvement on the operational metrics, and obviously we got some benefit from the FX also. So that's why if you look at a services level, we have 6.7%. My sense is if you take off some of the one-offs, because these comparisons are to the quarter four, if I look ahead to next quarter, I think this 6.7% could go to 9.5% for services, plus minus, 0.5%. That's what it means in terms of the one-offs, because some of the restructuring costs and other elements will not be there in next quarter. And for the group, I would say that some of the gap which is there in DLM is a one-off. We had some write-off of inventory. Also, we had more mix of low margin jobs in this particular quarter. We expect that gap to go down, and at least we expect us for the group to go around about 8.5% plus minus 0.5%. So I think we will be back, as we had said in the last time, we will be back to the quarter four level of margins in quarter two with these initiatives. Just go back to the earlier slide, please. In terms of profit after tax, I think it has been a good quarter for us. We have also got some export incentives. We have disclosed the amount of that. That's about 510 million INR. We have disclosed that as part of the other income, and that's showing up both in profitability and cash. But I think in these tough times, we have focused on various recoveries both from the government as well as from the customers, and that focus has helped us both on P&L as well as on the cash flow. ETR, I would say quite normal, little bit higher because of the tax on the export incentives that is there, and I would say that's what is reflective tax rate. Quickly, I'll go to the cash flow. I think we have generated during the quarter one of the historical high cash flows for a quarter, 2163 million or 216.3 crores, and the conversion is 138.1%. I already talked about FTIs, that has the export incentive that has helped us. This is the annual incentive which is there, so this will not be there in the rest of the year. And also some of it is also when you have the decline, the potential to recover on the working capital is high. So these are two things which have helped us. But in terms of the cash conservation, we have really applied ourselves on various incentives, be it collection from government, collection from the customers. We have looked at various incentives either from the government side or any other incentives. We have also looked at working capital management. There is a significant drop in inventory. Our payable days we are trying to improve. So there's a lot of focus, and that's how, both in terms of our cash position and cash flow generation, we are doing fine. And I can assure you that both for H1 as well as for the year, this focus will continue, and we will generate a cash flow at higher rate than what we have generated in the last year and last couple of years. I just want to also mention here that some of you had problem in reconciling the free cash flow with the SEBI format of results. So we have aligned that, and now you will find that our free cash flow is aligned to the SEBI format. We have stated all the numbers in the same line, but again I would say because of the restatement, the impact for the current period is about 7 crores for any of the periods. In the earlier also is not more than 10 crores, and it works both the sides. So I'm just saying this recast is just to make sure that we follow and don't have any confusion as per your request. But in terms of the numbers, it's very it's not going in one side or the other side. So if you have any questions, more than happy to explain that. But the cash flow is 2163 million. Had we continued with the earlier method, the change would not have been more than 10 crores. I just want to say one more thing in terms of some of the details like other income and hedge book. We have moved them to the annexure so that we can spend more time on the questions and answers. In terms of hedge book, we continue with the same policy, and the trends are similar to what we discussed in the last quarter. Nothing to worry. And other income are already details are provided in the annexure. So there's no reduction in the disclosures. Just we have moved them to the backup so that we get more time to talk to you. With that, I hand over to Karthik to give the insights into the business side.
Sure, thanks Ajay, and good day everyone. Hope all of you are safe and your loved and near ones are all safe and secure. And I would like to take a quick deep dive into the vertical details. And as you can see from what Ajay talked about, the overall services revenue at 112.2 and the DLM revenue at 18.4 and the overall revenue at 130.6, which is about 11.6% drop in QOQ in constant currency, and in dollar terms is 12.5% degrowth. And the key thing that I would like to highlight is about what we have seen on aerospace and defense, which has seen the maximum impact, as you can expect it to be so. And due to significant amount of ramp downs in terms of the customer programs or delays, and they were really impacted heavily on the commercial aviation side, while the defense continued to be robust. And we have seen that the travel had dropped to the extent of 90% in April, while it has recovered to less than 40% by June. But we continue to see this challenge in the near term as well. And coming to the other verticals, whether it is communications, E&U, and both have seen moderate degrowth, and we expect them to start getting to the growth path as we move forward in Q2. And coming to transportation, and we have seen an impact with one of the customers and we see that this is likely to get to the growth trajectory from Q2 onwards. And from portfolio of semiconductor and medical technologies, the pipeline is looking robust, and we expect the growth to continue in Q2 and Q3 as well. And portfolio and semiconductor would be muted as the demand is completely uncertain how things are going to really pan out. And in summary, what we would like to call out is communications and utilities and medical technologies are likely to see a robust pipeline and growth for Q2, Q3, and Q4. And the rest of the verticals would probably be muted, and A&D would be impacted even in Q2 to some extent. And I would also like to highlight some of the key trends that we are looking at and what we are really hearing from customers across each of the verticals. And aerospace and defense continue to see a challenge even in Q2 due to the passenger travel demand reduction. And we are actively working with customers on digital, defense, and DLM. I think these are the three strong propositions we are taking to the customers. And coming to the communications part, we are seeing that network upgrade and fixed wireline to wireless and the technology upgrades from customers. And there is a natural tendency of network expansion by 15% in terms of demand, and that need to be addressed by telecom operators. And they need to really invest on upgrading their network. And we are excited to participate in some of the investments in 5G rollouts, and we are also looking at the expansion in fiberization across Europe and other geographies. And we're also looking at investments in technology areas within communication vertical, whether it is on SD-WAN or IoT and some of the inventory management areas. Can you go to the next slide? So moving along, transportation, we continue to see a positive traction. And as Krishna talked about, we are able to enter 2 new customers during this crisis. And we are seeing the momentum in Q2. And we hope this continues for the rest of the year. And most of the customers don't see a shift in the right in terms of project execution. They're wanting to really keep the projects on schedule, which is a good news. And energy and utilities, and we have seen a strong momentum in utilities, and especially on the RFPs, which are stuck for a while in Q1. I think they've started getting back to normal mode of execution, and we hope some of the pipeline will get converted in Q2 and Q3. And medical technologies, I talked about this earlier, and we are definitely seeing momentum in both the DLM as well as on the services business. And we are already supporting one of the medical device customers in terms of expanding on the manufacturing requirements on the COVID-related diagnostic equipment. Yeah, semiconductors has been mixed in terms of what we have seen, and some part of medical devices related ASIC design I've seen a momentum, and digital ASIC designs I've seen a momentum. At the same time, some of the verticals like automotive and industrial are seeing muted demand, and so we are seeing a mixed reaction from customers on the semiconductor domain. And design-led manufacturing, and there is a robust opportunities that we see, and both in terms of demand as well as improving our operational efficiency. What I would really like to highlight, the focus for the next 1 to 2 quarters is to bring our cost of operations, the inventory reduction, and ensuring that we are able to increase the cash flow generation for this business. That's a key priority that we have for the DLM business. And net overall, what I would like to summarize is the pipeline is robust, and the sales and customer engagements have been happening at a higher engagement levels than what we have seen before. And the operational and delivery rigor is gaining momentum, and we are confident that we would probably look at Q1, Q2 as our bottom and expect to really start getting back to growth. And except for A&D, we are confident on all other verticals to see a momentum in Q2, and maybe A&D would start getting back to the normalcy by Q3, and we hope the growth coming back to the levels that we have seen before from Q3 onwards. So that's a quick summary on the business outlook, and I really wish to request all of you to continue to be safe and wherever you are, and we will be happy to answer any of the questions.
Thank you very much. We will now begin the question.
If I may just add one more comment before we go to the questions. I just want to give a quick color on the outlook for Q2 and FY21. As you saw, the revenue for Q1 was better than what we had expected. We had originally said we were looking at potentially between a 15 and 20% degrowth. That really came at 11.6% in constant currency. We are seeing growth coming back in all industries in Q2, except in aerospace and defense, which will degrow in Q2. And overall, this will be a tough year for aerospace and defense. And taking all that into account, and also the fact that while there will be growth in most other industries, like I said, we still expect a double-digit degrowth in revenue for the year. In terms of EBIT margin, most of the one-time cost actions are done in Q1. There are a few things in Q2, but most of them are done in Q1. But as we mentioned in the last call, we still hold that. That is, in Q2, we will be back to at least the Q4FY20 levels, which was about 8.6% or so. And we will be back to the first half of FY20, which was in the closer to 10% range in the second half of this year. Q2 PAT will not have the benefit of export incentives which we received in Q1, and taxes will also therefore be marginally lower in Q1. So this is the outlook for the rest of the year.
Thank you. Sir, should we open the floor for questions?
Yes, please. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question, you may press star and 1. First question is from the line of Urmil Shah from IDBI Capital Markets. Please go ahead.
Yeah, hi, good evening, and thanks for taking my question. And thanks for sharing, the segment-wise outlook, especially for the second quarter. Krishna, my first question is regarding the same. While we understand as regards aerospace and defense to be peak, but would any of the verticals see a strong growth to the extent that they can overcome the cut which was visible in Q1?
So, Urmil, I think what we're seeing is that aerospace and defense will have a fairly significant cut. So I don't think any of the verticals can make up for that, at least through the year. Now, with some of the verticals will make up for the cut that is there in Q1, so which means that net for the year that they will still have a growth. So we're still working on that, and we believe that some of the verticals have a line of sight towards that. Karthik, do you want to add anything to that?
No, I agree, Krishna. What we are seeing is it would still not be possible to cover all the gaps, but our intent is to really get as close to the gap as possible that we can mitigate. And the way that we are really looking at is Q3 being a soft quarter, and we expect the growth to really get back to the normal levels by Q4. And by the time it will be a little too late for the first 9 months of degrowth to be covered. So that's the concern that we have at this point of time. But we are definitely seeing the pipeline across all the areas, and especially around the digital, and whether it is helping the customers on digital asset management or track and trace or Industry 4.0 or grid modernization. And I think a lot of interesting areas that we are seeing opportunities coming up from various customer segments, which is definitely giving us positive momentum into Q2. And we're also seeing that the decisions which were paused somewhere in middle of Q1 have started getting back to the normal mode end of Q1 and early Q2, and we hope the momentum to continue. And we are also concerned about some of the changes that were happening in terms of the COVID wave 2 or wave 3, which was, call it as the lockdowns in various cities in India, and we are absolutely keeping a close tab in ensuring that our people are safe and we are able to really operate at a very lean percentage of people operating from office. And we still continue to have more than 90% working from home. And we thought we can probably get to about 10-15% by early Q2, but we are deferring that decision because we are able to operate them at more than 90% productivity levels. So keeping that in mind, we are able to continue the way in which we were doing earlier. And we are keeping a close tab on changes that are happening around us. And we hope some of the field-related issues that we have seen in the early part of Q1 don't occur in Q2. And that's another part that we are keeping a close tab on.
Sure. And given this outlook, as regards the double-digit decline for the full year, are we talking about mid-teens kind of decline or lower than that?
No, so it won't be mid-teens. It will be lower than that, i.e. closer to 10%.
Sure, thanks.
It won't be mid-teens, but it will be closer to. We don't know where exactly, but it won't be in a sort of a mid-teens kind of a number.
Got that. And you elated an interesting point as regards focusing on the non-top 5 clients. It would be good if you could, share which would be the key verticals to be looked at. Because if I'm not wrong, it's not only about de-risking top 5 concentration, but also de-risking the A&D dependence.
Karthik, do you want to address that?
Yeah. No, I think you're absolutely right, Prashant. I think what we are definitely looking at is to double down on some of the verticals like communications, utilities, and medtech. I think we definitely have about 24 customers in those segments, which can probably be mined better. I think that's definitely what we are looking at. When Krishna said we want to really look at the customer concentration, I think we have a gold standard customer base within many of the verticals. And the intent is to really bring in more mining within these customers and bring more digital deals, engage the customers more positively with proactive ideas, and making them to realize how we can really co-develop some of the products and solutions. I think those are the areas we are really focusing on in terms of expanding our growth from the top 30 accounts. We are looking at how do we really grow from the 6 to 30 accounts higher than what we can do from the top 5 accounts. I think that's what Krishna meant.
Sure, thank you. My last question, if I can pitch in. Krishna, as regards capital deployment, more on the point of view of M&A, how should we look at it FY21? Or you would want it to be more of a year of stabilization as regards the organic growth?
So, Urmil, the way that we're looking at it is obviously right now all hands are on deck for the organic growth. So we are continuing to be very focused on that. Going forward, though, we understand that there will be some good assets that are available at a reasonable price. So we're making sure that we're doing the pre-work that is required to be ready when the opportunity arises. So I would say at this, in the immediate term, we are backing off a little bit because I think some of the assets need to be evaluated in the new construct. We can't just assume it's the old construct. But the idea is that we're using this time to really scan the market, understand the market, while we focus on the core operations. But my view is sometime towards the end of the year, we will start to see a lot more activity on that.
Sure. Thank you. All the best and stay safe.
Thank you.
Thank you very much. Next question is from the line of Madhu Babu from Centrum Broking Limited. Please go ahead.
Yeah, hi sir. So on one of our large vertical will have anyways the structural issues for some time. So in terms of communication, when we are saying the growth, so could we tell them in which geography, like in the large Australian client, what are the new opportunities we are pursuing, or what are the typical deal sizes which we can expect from the large Australian client as well as the large US clients in communication vertical?
If you want me to take it, yeah. Yeah, thanks, Madhu. We are definitely seeing growth all around as far as the communication is concerned. I think we have definitely seen a momentum from APAC, which is what Ajay also talked about. And what we are seeing is the 5G rollout, and we have been able to secure about 60 sites. And we expect if you're able to do this, it can probably grow multifold. And we have seen something similar across North America as well. And as I talked about, the expansion that we are looking at is what can we do on the wireline and fixed line, and also expanding into wireless and technology areas. And we are seeing growth momentum across all the three segments. And from Europe side, we are really trying to get a right level of partnership that we are looking for to ensure we can expand on the European geography. So the fiber density in Europe is likely to go by 5x in the next 6 to 8 years. And how do you think we can expand on our existing offering on network planning and design that can be expanded in the geography? So we are looking at this vertical as a growth engine for this financial year and also for fiscal 22.
And sir, whom would we encounter in competition? Would it be the typical Indian IT service providers in these deals? Because it's not completely engineering side, it's on. So when network and all, maybe companies like Tech Mahindra or typical other IT vendors, or so who would be the competitors in this deal, and how would we need to expand the delivery team to align to tap these opportunities? Because relatively we have been more on the not much into this space.
Yeah, that's a fair question, Madhu. I think we have been internally debating about how do we get ourselves prepared for, and we are definitely looking at build partners as an approach that we are looking at for expansion. And especially on the partnership, we are looking at IT and platform-based growth, and that would really give us significant headway into right to win. And we would come across some of the large SIs, and what we are trying to expand is from our existing base to adjacencies, and that's where we see a growth that is coming in, whether it is from network planning and design to asset management and expanding into the inventory management. How do you think we can really expand on the service fulfillment, service assurance? And those are the areas that we are seeing as natural adjacencies and trying to expand on the technology side.
Okay. And one last question on the semiconductor, which typically is a large vertical and with large deal opportunity. So last time we have done one acquisition, Ansem, and after that, so I mean, would we require further acquisitions to bolster the scale of this vertical? And so how do we see, I mean, probability of any more large deals in this vertical? Because it's a sizable vertical. Yeah. Thanks.
Yeah, that's a fair question, Madhu. And what I would really answer is we wanted to really make some of the investment that we made. How do you think we can really make that to grow significantly for us? And we want to really take the capabilities which are very unique and niche and much differentiated as compared to any of the Indian SI. I think we really want to take those capabilities and expand our presence in medical devices and defense electronics and the industrial side of the business. I think that's where we'll see a growth coming in. Though we talked about semiconductors, and these are the ASIC custom design for customers who need to design their own chipsets because of the need that they see that they want to create a secret sauce of their IP to be embedded, and that's where we come into picture. And we are really seeing that the opportunity we want to expand or cross-sell is into verticals like aerospace and defense and automotive, industrial, and medical technology areas.
Okay, sir. Thanks.
Thank you very much. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. Next question is from the line of Sandeep Agarwal from Edelweiss Securities. Please go ahead.
Yeah, thanks for taking my question. So Krishna, I have and Karthik, I have one question particularly on the outlook which we are talking about. So it is looking like we are going to have a significant tailwind over the next 3 quarters on a quarter-on-quarter basis, because what you're saying is that 10% decline is when it would mean 5.5% CQGR for next quarters, given aerospace is still expected to decline, it looks like there is a significant deal pipeline which you see will quickly materialize, or there is something else which is giving you so much of preference. So if you can put some light on that, will be helpful. Secondly, on the margin front, we have achieved quite a bit of restructuring. So I would like to know, Ajay, will this not structurally improve our margins by Q3 and Q4 to that extent, because probably we would have achieved the right fit number of employees with this restructuring effort, or you think there are some costs which are unpredictable right now?
So Ajay, why don't you start off with the second part and then we can come to the first part.
Thank you, Krishna. Sandeep, you're absolutely right. I think what kind of cost structure that we have created gives us a lot of confidence for a good margin for H2. And that's why Krishna also said that, in the outlook that H2, I think we can get back to the levels of 9 moving towards 10% kind of a margin. And this is, assuming the not extraordinary growth, because the growth also has an impact. So I think it could be a little better than this, depending on some of the growth, which is little uncertain right now in terms of saying what will be that CQGR. But I'll leave Krishna and Karthik to take that. So your observation is right on the margin.
So Sandeep, I'll just quickly say that, it's not going to be just 10%. It won't be 15%. It will be somewhere in the middle. So we really need to, we're still working through to see how the numbers will pan out for the year. So I will say that first. And the second thing I'll say is, look, we do see a fairly decent pipeline. We see a fair amount of opportunities that are still there. Obviously, we also have to be very careful because the macro situation can still change. So we do need to be careful that we're not just going whole hog in and making some large investments. So we are treading it cautiously. But I want to say that, the growth will be in double digits, which means it will be greater than 10%, perhaps not quite 15, but somewhere in the middle. And we do see a fair deal above pipeline and opportunities to be able to get there, because, aerospace, fine, we will have a challenge. I think we have to brace for that. But like Karthik said, there are other verticals such as communications, medical, etc., where the opportunities are also there. Karthik, do you want to add anything to that?
Yeah, I think you covered it, Krishna. I think it's true. What we are seeing is a good momentum. The decision making will depend on multiple other parameters from customers, and customers are also bracing for their cash position and their readiness to continue the investment. So it is definitely not just what we can do with them. It is also their readiness to make decisions. So there are decisions that are getting delayed. There are decisions that are getting pulled up, and we are seeing a mixed response from various customers. So on the medical devices side, we are working on 2 deals where we are in the last leg, and we hope some decision will come through in Q2. And similarly, we are looking at a couple of deals in utilities and a couple of deals in communication. And we are expecting the decision cycle to improve in Q2 if the macro situation remain stable as we are seeing today.
Okay, great. Thank you. That's all from my side.
Thank you very much. Next question is from the line of Sudhir Guntupalli from Motilal Oswal Financial Service. Please go ahead.
Yeah. Good evening, gentlemen. Thanks for taking my question. Krishna, our revenue dropped almost 16% over the last couple of quarters since COVID situation started. If you were to dissect this decline further, what part of it would have been supply-led and what part of it is demand-led?
Krishna, I'll answer this question. What we have seen is, Sudhir, the early part of Q1 and between April 1st to April 3rd week, there were issues related to the supply side, and both on the DLM as well as on the services part. But I think most of the services related disruption have been recovered through the quarter, and the team has done a phenomenal job in pulling things up in May and June. And to that extent, I think we do not have much of issues on the supply side. We still have 1 or 2 odd cities where we are not able to have the field related activities, which is affecting us slightly, but we don't see that as a major issue on the supply side. And what we have seen the issue on the second part of Q1 is on the demand side of the challenges, and that's the reason why we have seen a drop in the revenues.
Okay, but it looks like work from home in case of engineering services is not being as convenient as in the case of IT services. So with the entire medical situation still remaining fragile and possibility of reimposition of lockdowns, so do you think supply side will not be a big bottleneck going forward? As in, you're confident that supply side will not be a big bottleneck going forward?
Yeah, I would answer it slightly different. The way that we have looked at it is we could have asked us around late March. Do you think you can get to 95% work from home at 95% productivity levels? Their answer would have been maybe. But I think we are confident to say that now that we have been able to bring in all the processes in place in ensuring that people are able to work productively and be able to manage their working hours, and we have been able to really overcome most of the challenges that we have seen in the early part of Q1. Having said that, when you talk about supply side, I would also look at our ability to hire locally, especially in US. And we have close to 80% plus people that we have in North America who are hired locally. So we have a strong resourcing engine that can help in hiring people locally. And the travel part could probably pose some issues in the H2, since we are not able to really get people to move from one place to other place. That's where the local resourcing engine will come into picture. So to that extent, we hope whatever the visibility that we have for Q2, Q3, we don't see the supply side to come in for any challenge.
Sure, sir. Between DLM and services, how would your annual outlook be spread? Whatever 10 to 15% in between, you're talking about, let's say 12-13% sort of a decline for the full year. So any individual color on these two segments, separate color on these two segments, services and DLM? That's it from my side. Thanks.
Krishna, you want to take?
Yeah. See, I'd say it's a little bit early on that. I think we're seeing opportunities in both cases. I think DLM looks a little bit better, but I think at this point, considering how volatile the situation is, I would say let's look at it quarter by quarter, and I would say overall it's quite well balanced.
Sure, Krishna. Thanks. All the best, and thank you.
Thank you very much. Next question is from the line of Sandeep Shah from CGS-CIMB. Please go ahead.
Thanks for the opportunity. Just wanted to understand, Krishna, under your and the joint leadership with Mr. Karthik, is there any major restructuring which we are planning to do in some of the department to improve the predictability of the revenues, and also the revised strategy may also target focusing more on the large deals, because at a scale that may be required. So can you throw some light which will help us as a long-term strategy?
Absolutely. So I'll say a couple of things on that. I think we have done a lot of work, and especially Ajay and the finance team more than anybody else have done a lot of work on bringing predictability based on some clear metrics, right? Be it order book or pipeline and so on and so forth. And Karthik has really used that very effectively to make sure that we're having reviews and cadences, which gives us a much better visibility into what is going on. So one is, I'd say we've already done a lot of work in terms of making sure that we have a scientific way, and obviously we're not finished yet. We still need to do some more work, but we'll continue on that. And I think that was one of the big challenges that we had, especially in the last 4 quarters or so. The second thing is we're also looking at a few options of how we can get large deals going effectively. Again, restructuring can come in many formats. I wouldn't venture on that. But I'll say that we are looking at ways in which we can bring focus to large deals. And I think even over the last quarter or so, both Karthik and also the BU heads have put in a lot more effort on bringing those kind of deals into focus, which we perhaps didn't do in the last 4-6 quarters, which I think is happening. So we understand, a couple of things, both in terms of where we should focus on and the outcomes, which are areas of focus, and we're working on how we can support those areas of focus.
Okay, fair enough. And just to clarify, if I'm not wrong, are we seeing in the services business in 2Q, the decline in aerospace and defense would be higher, which will not be compensated by the growth in the other areas? And also in 3Q, because of furlough, services business may be tepid. So it may be largely the services business may see a recovery only in 4Q. Is it a right way of looking at it?
No, I would say in Q2, what I said that was for the year. I'll say Q2 is looking better than Q1 as things stand. But for the year, what I said is there.
But service business will see a positive growth in 2Q as well.
Yes.
Okay. And Krishna, just last thing, as even at a midpoint at 12.5%, the consolidated compounded Q-on-Q growth comes out to be close to 3% in the 2Q to 4Q. So this is the services part you believe may be slightly lower than that, and this may be more dependent on the DLM part?
Not necessarily. I think again, like I said, it's too early. I think both groups are looking, very similar right now. We do see more opportunities in DLM, but services also is looking reasonable. But I'd say DLM might be slightly higher, but not. I mean, it's not all DLM-led rebound.
Okay. Thanks, and congratulations on a good execution.
Thank you.
Thank you very much. Next question is from the line of Mohit Jain from Anand Rathi Shares and Stock Brokers. Please go ahead.
Hi, sir. Two questions. One is on your order intake. So this number includes Hitachi for the quarter, or will it come, or where will you book it? Will it come in the next quarter?
No, see, the way that we do order intake is Hitachi is not one large PO. Our order intake that we report is only on committed purchase orders. So Hitachi is not one large PO. So it will happen over a period of time. It's not a one-time. So, for example, we only take, even when we sign multi-year deals, we only take what's actually committed from the customer as a PO.
So that is already included in the quarter's intake number, is it?
Only what is committed.
Only what is committed and signed is already part of it, is it?
Which is not a very large number.
That I understood. And second?
Yeah, because committed is not what's committed in the MSA, but what's committed through a purchase order, which is a legal document.
And sir, given our order intake, this number, while you have added a footnote saying that it could be more than 1 year, is it safe to assume this is broadly for a 12-month period?
So, Ajay, do you want to take that?
No, I think when you look at our order intake backlog, I think we look at two metrics. One is what is executable within the year and what is beyond this. So this is a sigma of both of them.
Sir, on a weighted average basis, because as Krishna mentioned, we only take POs which could be of shorter duration. Like any ballpark will do, like 1.5 year of, because you have specifically added it could include more than 12 months kind of a business also.
So that's the technical definition of order intake. And typically, if you look at, when our backlog is 6 months, you will find that, I think it depends on any particular typical deal, but I would say that, it is just to explain that the order intake comprise of both executable in financial year 21 and beyond. Don't read too much into it beyond that.
Okay. And second, sir, on the headcount reduction, is it like complete now, or because going forward we are also looking at growth on a sequential basis, or do you think some of it may come in second quarter as well as part of restructuring?
See, we've had to take some decisions which we obviously implemented in Q1. So we believe we have the right base, and we also have the right number of people for the growth that is going to come. I mean, obviously, in a volatile situation like this, things keep changing, so we will have to make corrections. But broadly, we think from a wider structural restructuring basis, we're done.
So is it like safe to assume our cost base, I mean, as of today, given that we have an outlook as of today, our cost base is more or less fixed, and your margin outlook is basically a function of how much incremental revenues can we generate in the second half?
Ajay, do you want to answer that?
See, first is, as Krishna said, I think more or less we have done that. But, when you do these exercises, there are always spillovers. I would say it's little bit of spillover that is there. And I would say that, we are continuously working on utilization, and that's what we are doing. So I think some of the growth can come with existing cost structure also, but beyond a particular point, it would mean additional cost. And right now, we really don't know precisely that, how much is the growth. But definitely, if the growth comes back, we will have to increase some of the costs. But whatever margin we are saying that, we will get to Q2 at the Q4 levels, in H2 to the annual levels, I think that's factoring into that incremental variable cost that will come back with the growth. So that is net of that.
And sir, lastly on utilization, like what could be our range of utilization as of today or as of 1Q?
So,
sorry, go ahead.
Yeah.
Go ahead.
No, please go ahead, Karthik. Karthik.
No, I think we feel that there is additional 3 or 4% potential opportunity for us to improve on the utilization part. And I'll also add one more point, Mohit, which is to do with automation. I think we are starting to really bring focus on automation, and we see an opportunity as a lever of productivity through automation. So that's something we are trying to really put in place as part of a key initiative that we are trying to drive on the operational improvement side. And also on the order intake, I'll just add one point, Mohit, because of multiple challenges and turbulence that we have seen on Q1. I would not read much into the order intake that you have seen on the first 3 months, because a lot of things would have got corrected by the time the Q2 had begun. So this was only whatever as on 30th June that has been reported there.
Understood, sir. That's all from my side. Thank you very much.
Thank you very much. Next question is from the line of Rajan Ranjan from Geojit Financial Service. Please go ahead.
Hello, sir. Hello.
Yes, we can hear you.
Yeah, thanks for the opportunity. I have a question, like, in which particular sector will be your focus, like segment, like DLM, or whether it will be services in going ahead?
See, it will be a balance of DLM and services. I think services is still the core of what we do. So proportionately, a lot of our focus does go into services. So we are, like I said, it is the core of what we do. DLM really supports the services business for the most part. So the focus will continue to be on services.
And regarding this A&D, is this especially related to COVID, or like any client-specific concerns are also?
No, see, if you look at the global aerospace and defense aerospace industry, it's down very significantly, right? I mean, it is related to COVID. So therefore the cuts in the customers have put off a lot of their spend, have put off a lot of their engineering, and therefore it is very related to COVID and the COVID from a demand perspective, not necessarily from a supply perspective.
Okay. Sir, and the semiconductor division, we are focusing on IoT also, like. So how do you see this IoT vertical going ahead, like?
See, that's a very broad way to look at it. I mean, there's many specific things that we do over there, and the growth opportunity is really on how we position and package these things like connected vehicles. Like I said, we did an IoT device, which is a very unique hardware software solution. So net, I think there are some huge opportunities for us in IoT, and we will continue to focus on that. And not just, see, I think the key I will say for us is not to focus on the technology, which is IoT or digital, but to really focus on the outcome, which is connected vehicles, predictive maintenance, asset management, factories of the future, etc. So it's an important play, but it's an enabling technology to a wider play.
Okay. So one more clarity regarding that margin, like 9.5%, like you said, it's for the full year. I think somewhere Ajay sir said like 6.7% from 6.57% to 9.5%.
So what I talked about, first I explained that what will be the margin excluding the one-offs if everything was same, then how the Q2 will look at, looking at the one-offs between Q1 and Q2. So all comments were about Q2, and I said we will get back to the level of Q4 That's about 8.5% plus minus 0.5%. Then I said in H2 will be better than that, and we'll move closer to 9 to 10%. I think rest of it will be depending on the weights of the revenue, which I don't have right now, but I think it's a simple mathematics.
Okay. Thanks for the opportunity. That's all from me.
Thank you.
Thank you very much. Next question is from the line of Prakash Chalan from Marathon Edge. Please go ahead.
Hi. Just a quick question on the aerospace defense. Last time you had indicated roughly 20% is defense, 80% is aerospace. I'm talking only about the services business here. Within the services portion alone, aerospace alone, not the defense part of the aerospace, could you give me some sense as to whether how much of this is linked up to, is there any linkage to, what Boeing and Airbus delivery schedules look like? Is there any connection with that? Have you ever studied a correlation between the two? And is the nature of your work kind of linked to that, or is it kind of dependent on something else? Could you give us some color on aerospace defense recovery, what metrics we can look at? Is it really deliveries of aircraft? Thanks.
Yeah.
Commercial.
Can I take that?
Yeah, sure, go ahead.
Yeah. No, I think this is one area that we are also trying to work with along with our customers. What we have seen is it has to start with the domestic travel, and probably about 70% of our revenue on the commercial aviation would be linked to the domestic travel. When I say domestic travel, within US, within China, and within countries in Europe. And the second recovery would be based on the regional, inter-region travel, whether it is within North America, within Europe, within ASEAN. And the third would be the intercontinental, whether it is transatlantic or trans-Pacific, would be the recovery that we expect. Each of the phases could be anywhere between 3 to 4 quarters is what we are anticipating. And probably I would say 70, 15, 5 is what our 70, 20 and 10 is what I would really say how our revenues are linked to that. Because we work with a lot of customers who are into the short haul flights as compared to the long haul. And that's where our revenue recovery would be linked to.
So when you say short-haul flight and you say travel as opposed to deliveries of aircraft in production, is the nature of your work more linked to, maintenance sort of work when flights take off, land in terms of data, continuous monitoring and so on? And you're saying it's not quite linked to delivery schedules of the main aircraft manufacturers like Boeing and Airbus. Could you explain why it would be linked more to travel as opposed to deliveries of aircraft?
No, that's an interesting question where one of the customers did share with us, saying that if they got 100 planes and they are only requiring to put 50 planes to service, and they don't need to get the maintenance done for this 50, even if they demand one, because they can really put them back into the warehouse and start getting the other planes to be put into service. So it is going to be an interesting times that we live in. So we will really have to look at how things would evolve. It's a combination of all three. It's number of new aircrafts that require to be delivered. It is also ensuring that many of our customers do have linkage to the aircraft that flies, what they call it as a pay per hour, and kind of contracts. And the third would be linked to the MRO and maintenance side of the business. So all three have to be looked at in total, and you will find that it's a combination of all three factors that determine the revenue recovery for our customers.
Prakash, just to add to that, a lot of the work that we do is MRO related work, which means that only as the planes are flying do they need to get repaired, and we do a lot of the associated engineering. So a significant portion, to Karthik's point, a significant portion is that's why planes need to start flying. And also I'd say the other thing is only when that starts happening will the deliverables also go up, because the second big dependency for us is also on manufacturing starting to kick up, because a lot of the work that we do is also supporting manufacturing engineering. So unless manufacturing comes back on steam, which won't happen unless our aircraft or airlines are taking deliveries, and now they're not taking any deliveries, they're just keeping them in the they're rather paying the penalties than take the deliveries. So I think the air traffic has to pick on, because right now there are not many new programs that are going on, right? There are not too many sort of new design programs that Boeing or Airbus are undertaking, which means that the long-term kind of engineering, which is not dependent on any of this, is very little anyway. Even that was the case over the last 2 years. That's why aerospace business has been flat for the last year and a half.
Got it. So just to understand, make sure that I understood it, you're saying majority of it on the commercial side is probably MRO-related work, and a combination of it would be manufacturing engineering. Manufacturing engineering portion is linked to deliveries of aircraft being taken on by airlines in production, and MRO work is related to them flying. All right, great. Thanks so much for that. Thank you.
Thank you very much. Next question is from the line of Hitesh Jain from Federal Bank. Please go ahead.
Hi. My question is regarding Cyient DLM. There was a negative increase in the EBIT. What would be the reason for that?
If I can take that. No, there were one-offs, so I think you should not worry too much about it. We anticipate in the next quarter itself a swing of about 7 to 9% quarter on quarter on this EBIT. And the reason for this negative EBIT was the inventory write-off that was one time done. I would say that was more of a provision as part of the prudent policy we have about 365 days. And also the mix of the revenue, where we got more of low margin work in this quarter. There was a change in the mix last minute. But I think both of them will change in the next quarter. So you would see a huge swing in quarter two to the levels of 7 to 8% quarter on quarter. So minus 4% should be more like 4% plus minus 1%.
All right. Thank you.
Thank you very much. The next question is the last question from the line of Sonal Kohli from Boher Investment Advisors. Please go ahead.
Thank you for the opportunity. I had two questions. In the last couple of years, we have done a significant amount of capex, and we haven't seen too much of hiring in last couple of years. That was one. Secondly, apologies if this has been answered. I joined late. Did you give any guidance on Q-on-Q growth for the next quarter? In your services business.
So let me answer the second one. We said services will be better than Q2 will be slightly better than Q1.
And sir, would you expect Q3 to be better than Q2? Because
honestly, at this point, the way things are, I would, even looking a quarter ahead is not. At this point, what I tell you now won't hold for Q3. So I think we're also trying to look at our business. We know what's going to happen between the rest of the year, broadly speaking, but I think it won't be very prudent to guess in great detail on how different Q3 will be from Q2.
You did substantially better than what we had guided for. So where did the supplies come from? Were you building in much more supply disruption, or did the demand surprise positively, or any particular segment that surprised you positively?
So I think it was a combination of all the above, honestly, that we were expecting a lot more disruption from the supply side. For example, we did not think that we could get to, basically 95% work from home with 95% efficiency within about 4 weeks. I think Karthik mentioned this before. At the beginning of the quarter, if somebody said we would be in this situation at the end of the quarter, we would have been quite happy with it, at least from efficiency and work from home perspective. Similarly, I think there were areas where we were expecting sharper drop in demand. That's not necessarily happened. Or there are also areas where there was a drop in demand, but it has come back. So it's just been a combination of sort of all the above. And I think it's also, we have to realize that our customers are also working through a lot of uncertainty in their business. So it's not like they're able to give us the predictability that they used to be, say, a year or two ago, or even forget a year or two, even 3 months ago.
And on the CapEx question, if I can
Yes, Ajay, please.
answer that.
Please.
See, if you look at our CapEx, a lot of it is maintenance CapEx. For the services business, we end up spending about 2.5 to 3.5% of revenue. A lot of it would be the maintenance CapEx, and some of it is, the expansion CapEx. Then depends which number you are referring to in terms of CapEx. We have some investments, which also come in some kind of expansion. Look at Hyderabad CapEx. That's a new investment. Some CapEx that we have investments we have made in defense side on the SDR. So those investments are ahead of hiring. So that is the only case. Otherwise, I would say that, I think to stabilize in terms of our normal CapEx, I think we should look at this number of 3 to 3.5%. Any investments, we will give you some guidance. Right now, I think we had the large one was Hyderabad. Other than that, I don't think we have any major numbers that will have an impact on our CapEx investment in short term, at least for this year.
So let's say, last year, what would have you been your maintenance CapEx, broadly speaking, in absolute terms, because revenue is fluctuating a lot, so percentage of revenues may be difficult for us to, figure out. If you could just give a broadly an absolute number for last year, what was the maintenance CapEx, and for this year?
See, typically this number will be, some of it is fixed, so keeping that in mind, this will be more 100 crore plus minus 10 crores. And, in terms of the software, hardware, and some of the other modifications that we carry out, I would say roughly, and many of this is mandated by our customers as part of the productivity improvement, etc. So roughly, I would say that 67% is quite fixed, which doesn't vary with the hiring or volume. So that would be about 60-70 crores of that. But if you really want to deep dive, we can have a separate call on that. I'm just trying to give you sort of order of magnitude.
Great. And sir, lastly, you had this one-off income of 51 crore. What was in this account of? And is it one-off in the sense that it happens once in a year? Or is it like, one-off in two sense of it?
Yes, it is. It happens once in a year so far, I think every year. And this is dependent on government policy and announcement of the government policy. This is towards the export incentives for software. And I think we keep providing the guidance on this from time to time. As of now, we don't anticipate any such income, especially on the services side, for the rest of the year.
Thank you very much. I will now hand the conference over to Mr. Krishna, sir, for closing comments.
Thank you very much. And once again, thank you to all the participants to join us, especially when this is this late in the day. As you know, it was a slightly better quarter than what we anticipated, but there is still a lot of uncertainty out there, and we just need to be prudent that we are, on one side, we're quite confident of where we stand, and also we have a very strong and healthy pipeline that we are working towards, so that gives us an opportunity to take advantage of this disruption. But on the other side, I think the macroeconomic situation is still very fluid, so we still have to maintain the agility on the flip side, that we react if things change very quickly. I just want to assure you that we are, it's a very difficult balance, but I think we have an extraordinary management team that is maintaining that balance as well as we can, and we will have some much better quarters going forward. Thank you for your support so far. Thank you for your questions, and if there's any follow-ups, we'll be happy to answer them offline tomorrow. But otherwise, have a good evening, stay safe, and we will again speak soon. Thank you.
Thank you very much. On behalf of Cyient Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.